Will the Fed actually cut rates? Or is the market in for a surprise? Ed Yardeni, president of Yardeni Research, shares his contrarian take on the Fed, inflation, and why the labor market is more complicated than it seems. Find out why Yardeni thinks official productivity numbers might be hiding the real story behind America's economic resilience.
My own probability on it is under 50%. I'll give you 40%.
Really?
I'm still in the none and done camp. I don't think they're going to cut. And they've got two more inflation numbers, and they got one payroll number ahead of them. And I won't be surprised if the inflation numbers run a little bit hot. And I think payrolls could be up 100,000.
Do you think it's more about inflation running warm, or that the jobs aren't as bad as we think?
I think it's, can I pick door number one and door number two? I think it's both. Did I win a prize? I think it's both, actually. I think the initial unemployment claims data suggests that very few layoffs. The continuing claims suggest that it's taking longer to get a job, but that may be related to companies concluding that they want to kind of hold off on hiring until they figure out how AI and other technologies might substitute for labor or augment the productivity of the workforce they have now. So it's a very funky labor market. But on the inflation side, it's not all about tariffs. The services inflation rates in the CPI and the PPI were kind of annoying. They were kind of stuck at 3 to 4%. And that's okay if durable goods prices are falling, but they stopped falling because of the tariffs.
Right. I highlighted that earlier. So do you think, Ed, that this is going to be a problem for the market if the Fed doesn't cut as much as the market is betting right now? Or is it a good thing because it wouldn't cut for the right reasons if the economy is doing well?
My opinion, it's a good thing if the economy is resilient, and we haven't quite gotten to 2% inflation because of the interruption with the tariffs. So there's no reason for the Fed to lower interest rates. Earnings are clocking in at an all-time record high in the second quarter. And the growth rate, instead of being like 3%, is more like 11%. We had the same thing in the first quarter. Earnings have been phenomenally strong, which is kind of puzzling because you would think margins are getting squeezed by tariffs, but you're not seeing that in earnings through the second quarter. It's really quite remarkable. And maybe the productivity numbers are stronger than we're seeing in the actual numbers. Maybe whoever's doing the productivity numbers should be fired. Oh, that's the BLS again.
Well, we got to get through NVIDIA and PCE in the coming days, Ed. We'll keep this one brief. Hope you come back soon. Good to see you.